then we can proceed and basically prepare what is required in part A, B, and C. And we said once you come across this question, what you need to do is you come up with a skeleton. So we come up with a skeleton of what is required in part A, the statement of profit or loss, the statement of profit or loss, which is basically for the year, which ended 31st of October 2024, for the year which ended 31st of October 2024. So we need to have just a single column here. And always we start with the revenue. We start with the revenue. Remember, we said as you come up with a skeleton, this skeleton, record the values you're given in the trial balance here. So, yes. So the revenue is basically the first item in the trial balance, which is the 278,400. We say that value, if for example you leave it at that point, it will still be marked. It will still be what? Be marked. Just leave it there. Then to this we need to less the cost of sales. Is the cost of sales given? Is the cost of sales given in our question here? No, because I can see in this trial balance, I can see purchases. In the trial balance, I can see opening inventory and so on. So how do we compute this? We take the opening inventory, that is the third item from the bottom of the trial balance. Opening inventory, that is 37,800. That is 7,800. So to this we add purchases. Purchases is still down there below accumulated depreciation in the trial balance, and that is an amount of 78,200. And then to this we less crossing inventory. I hope you can remember crossing inventory is in the additional information number 1. Note number 1. Additional information number 1, 43.2 million. In thousand of shillings, it will be 43,200. That is basically the inventory at the end. So then the number of adjustments which we make to this, for example, any depreciation should be added here. So remember you have this depreciation on right of use asset. We have said that this one should be included within the cost of sales, 18,347. 18,347. Yes. So then from there, we will basically compute the other depreciations. We include them here, and then we get the gross profit. So after getting this gross profit, we said we proceed and we add the other incomes. We add the other incomes. Remember, when checking for the other incomes within the trial balance, we check the items appearing on the credit side of the trial balance. Credit side of the trial balance. What do we have on the credit side? Up here, I can see we have revenue. Below that, we have something called income from investment. Income from investments, that is basically part of the other incomes. Income from who? From investment. So the income from investment, let's just record that here. In case there is an adjustment, we'll do it here. We record the final values here. Below that, we have ordinary share capital, retained earnings, 10% loan stock, account payable, deferred tax, bank balance. All those are basically not incomes. And then still down, I'm checking the items only on the credit side because all incomes have a credit balance. I can see accumulated depreciations. Are those incomes? No. So then I think maybe you can just leave a line here or two such that we proceed and we record now we record the expenses. So for the expenses, we go back to the trial balance, we check the items appearing on the debit side, but automatically we say in this question, expenses will be 3 here: distribution, admin, and finance cost. So where do we have the expenses? We check the items on the debit column of the trial balance. I can see we have land and buildings, plant. Then down there, I can see we have purchases. Below purchases, we have distribution. And I've said you can leave 2 lines here before recording the expenses. Distribution. So this one is an amount of 10,000. So below that, we have the administrative expenses. So the administrative expenses is 55. Is 55. That's basically what we have. 55. Then loan interest paid. Loan interest paid, that one is part of the finance cost. You record it here. You record it here as part of the finance cost. So which is basically an amount of 2,000. 2,000. But equally in this case, we have to recall that we have interest on leases. So this interest on leases for the current year, this one we have said is taken to the statement of profit or loss as part of the finance cost. So we add an amount of 69.74, the interest on leases, the interest on leases. So below that, we have dividends which were paid. That will go to the statement of changes in equity, opening inventory account, receivable. Then we have investment. So basically, we don't have any other expense. We will have the profit before a tax, and then to this we less what? We less income tax expense. Remember, we say that this income tax expense, this usually comprises of two components of taxes. This one comprises of two components of taxes, the current tax and also the deferred tax. So we will record the current tax, and this is given somewhere within the additional information, and basically the deferred tax. Remember, this deferred tax can either be a deferred tax income or a deferred tax expense. We will see what you're told in the additional information. Is it a deferred tax income? Is it a deferred tax expense? And then from there, we get the profit after tax. We get the profit after tax. After that profit after tax, what do we add? We proceed and we add other comprehensive incomes. We proceed and we add other comprehensive incomes. Remember, you say that these other comprehensive incomes, these include things like the revaluation gain or loss on PPE. So I think there is some information which is given in relation to that. You note number 2. And then from there, we will get what? The total comprehensive what? Incomes. Yes, so that is basically a skeleton of what we are required. So then we have a skeleton of part B. Part B, a statement of changes in equity. Statement of changes in equity. Statement of changes in equity. Now, for the statement of changes in equity, here we need to have, first of all, the details column. Details column. And then we go back to the trial balance, we see which items of equity was our company having. So remember, the items of equity, we consider share capital and reserves. So therefore, in the trial balance, we check the items appearing on the credit side. Items appearing on what? The credit side of the trial balance. After you can see we have revenue, income from investment. Are those items of equity? No. So then below that, I can see we have the first one, which is basically ordinary share capital. Remember, our figures here equally and in thousands of shillings. So below that, I can see we have retained earnings. Retained earnings. Retained earnings. So retained earnings. So then below that, we have 8% loan stock, account payable, deferred tax, bank balance. Actually, I think we don't have any other. What about in the additional information? Yes, I think in the additional information about there are some assets which were revalued, landed buildings. So automatically that means that we will have a column for revaluation reserve. Make sure you write that in full. Revaluation reserve. For your revision purpose, we will have revaluation reserve. You write that in full for your revision purpose. Revaluation reserve there. Yes. So then note number 3, 4, 5. I think we don't have any other items. So then we will have what? The total. The total. So what we start by recording here, and basically opening balances, and we say even by recording those opening balances, those are 3 months. Ordinary share capital, this one is 150,000. Retained earnings is 119,500, and then that one was 0. So no need of getting those totals because we say they are not marked by the end of the day. Then in the trial balance, even before we move now to what is required in part C, in the trial balance, I think I can see dividends. Can you be able to see the dividends which were paid during the current year? How much dividends were paid during the current year? Because that is something we need to capture here. The dividends which were paid, how much? How much dividends were paid during the current year? The dividends paid during the current year were 15,000. 15 what? 1,000. Remember, in this case, we say dividends are paid from the profit. So dividends paid dividends paid, that one deducted here. That is a free mark, 15,000, like that. You can equally take it to the last column, though whatever you have in the total column is not marked. Yes. So basically, by recording those values, those are just marks, free marks. So then we leave some space there. We have part C, statement of financial position. Statement of financial position as at 31st of October 2024. 31st of October 2024. 31st of October 2024. So equally here, we just need to have a single column, and we start by recording the non-current assets. The non-current assets. The non-current assets. So for the non-current assets, remember, we start by recording the PP. PP, we say that this comprises of all tangible non-current assets. And I think we have a number of tangible non-current assets. In the trial balance, we have land and buildings, and I think we have plant and equipment. So I think we will deal with that once we go through the additional information, because we must compute the depreciation for the current year. Yes. So PP, then the last item is the trial balance. The last item is the trial balance. I hope you can see we are given investment, and basically you're told that that investment is a long term. So if an investment is basically a long term, that is a non-current asset. That is a non-current what? Asset. And basically the value for that is what? 90. Will that have any adjustment? No. So a long-term investment is a non-current asset. The other item which you also need to recognize here is what you have computed here. This right of use asset. The right of use asset, we also recognize it here as one of the non-current assets. Right of use asset. And basically we recognize it here at the net book value. The net book value is this one minus the depreciation, which is basically 73. 390. 300 and what? And 90. Yes. Do we have any other non-current assets in the trial balance of the debit column? I can't see any other. So we move, and basically we record the current assets. We move and record the current assets. We move and record the current assets. We move and record the current assets. So the current asset, I think we have a number of them. Equally, we check the items appearing on the debit column of the trial balance. I can see landed buildings, plant and equipment. Those are not current assets. Down here, you can see we have purchases, distribution, admin, loan interest paid, risk plant rentals, plant rentals. This is the amount which was paid during the current at the start of the risk, 22 million. So that one is not supposed to be used either here or there. We have used that in computation of the risk liability and right of use asset. Okay, so below that we have dividends paid, inventory, account receivable. So we have account receivables. Account receivables. Account receivables is an amount of 63 200. Yes, I think we have that. Then finally, we have long-term investment, which is a non-current asset. Then in the additional information number 1, we have the closing inventory. We have the closing inventory. And actually, this closing inventory, no adjustment for that. No adjustment for that. In fact, we can just record that here. No adjustment for that. So then we have note number 2 is about landed buildings. Note number 3, we have dealt with that is about leases. Note number 4, we will compute, I think, the interest. Okay. In fact, I think first of all, we can just, we don't have any other item, because I hope you can see in the trial balance, we have the bank balance in the trial balance, but that bank balance is on the credit side. We say if it is on the credit side, it's upon you to know that is an overdraft. Being an overdraft, it will be recorded here as a current liability. So I think we have that. So then from there, what else do we need to do? We need to move and we record now the equity. So what we record at equity is basically what we get from this statement of changes in equity. So we will have the ordinary share capital. And I think this ordinary share capital, based on what you're given in the additional information, that value will not change. We will also have the retained earnings. And also we will have the revaluation reserve. Revaluation reserve. So the values we get there is what we will bring here. So then from there, we proceed to record non-current liabilities. Now the non-current liabilities, one, we have this risk liability. The risk liability. The risk liability. Now the amount of risk liability which we recognize here under the non-current liabilities, who can be able to tell us from this risk amortization schedule, which amount do we recognize here? I think I've already explained that. How much amount do we recognize here as a non-current liability? How much amount do we recognize here as a non-current liability out of these two values? Out of these two values, yes, if you check on what we did in that topic, this is what we recognize as a non-current liability. So 60, 182, 182. So that is one of the item of non-current liability we will have here. I think the other one should be the deferred tax. But remember, what we recognize here should be the deferred tax at the end, not the deferred tax which we have in the trial balance, but the deferred tax at the end. At the end. Then, still in this particular question, if you go back to the trial balance, the items we have up there, I can see somewhere or something given up there as 8% road stock. So 8% road stock, that one is an non-current liability. That one is an non-current liability, and I don't think the value for this will change. The value for this will not change. 50. So do we have any other non-current liability? I can't see any other. So finally, we record the current liabilities. Current liabilities, still we can start with the items in the trial balance. Below this 8% loan stock, I can see we have account payable. Account payable, the value for that is how much? Is 33,400. We just record there in case it has an adjustment, we do it. Deferred tax, that one should be recorded here. And then we have the bank balance. That bank balance we have said is a bank holding. How much is that? That is an amount of 12,500. 12,500. Yes, I think that's what we have. That's what we have. Now, take into account, we have now the skeleton. What do we need to do now? We need to go to the additional information as we make now the necessary adjustment. So let's go to the additional information number one. So number one, we are given the closing inventory. And actually, you have said that that one should be used in the computation of the cost of sales. Number two is a current asset. And actually, that one do not have any adjustment. So that's why we have recorded that there and also used in the computation of what? Of cost of sales. Number two, this point had some work. Let's go through it. We see what you're told. We are told that landed buildings were purchased in 1st November 2008. This is some time back, because if you check on the information which you're given here is for 2024. These assets were acquired some time back in 2008. And you're told the cost of land at the date of purchase was 70 million. However, on 1st November 2023, 1st November 2023 is the start of the current year, because you can see this year ended 31st of October 2024. 1st November 2023 is the start of the current year. However, on 1st November 2023, landed buildings were professionally valued at 175 million and 80 million, respectively. And then you're told the estimated useful life of the building before revaluation was 50 million. However, the revaluation did not change the useful life of the building. So I think we can deal with those two assets. Number one, we need to determine the revaluation gain or loss. Sorry, before we do that, there is something I've forgotten to record here under the current liabilities. The risk liability. Remember, there is a risk liability to be recognized here, to be recognized as a current liability. And actually, we say it should be the difference between these two values. Can you give me that difference before I do away with that table here? Give me the difference between these two values. I'm told bank overdraft equally is 15,400. Yes. What is the difference between these two values? because that is what we recognize here as a current liability. The difference between the lease liability in year 1 and year 2. Year 1, year 2. I'm told by Evans says 16,529. 529. Is that what you're getting? 16,529. Yes, that is confirmed. That is what we recognized here as a current what? As a current liability. Now, having that, we can go to that point number 2 on revaluation of RAD, revaluation of buildings. So the first thing we need to do, can we go back to the trial balance? We go back to the trial balance, and I want us, we have the cost of those two assets from the trial balance. From what you're given in the trial balance, what is the cost of those two assets? The cost of land, the cost of buildings. Yes, from the trial balance, what is the cost of those two assets? Yes, so from what we have in the trial balance, we're given that the buildings at cost, land and buildings at cost, which is 270. Now, if we go back to note number 2, we are told land and buildings were acquired back in purchased back in 2009. The cost of land back then was 70 million. So included here is the cost of land. The cost of land on the date of purchase was 70. So it basically means that the cost of buildings, is what? Is 200 million. That is the cost. Now, what we need to do, because these assets were revalued at the start of the current year, we need to determine the revaluation gain, or basically the revaluation what? Loss. We will determine this for individual assets. We start with RAD. So whenever an asset has been revalued, we compare two values. We compare the revalued amount with the cost. In case an asset is not depreciable, we know land is not depreciable. We'll compare the cost with what? With the revalued amount. But for buildings, we will compare the revalued amount with the net book value. So the revalued amount for buildings, as per note number 2, buildings were revalued at an amount of how much? We are told that the buildings were professionally valued at 175 million and 80 million respectively. So the revalued amount for buildings, for land, is it the one which is 175 million or 80 million? The revalued amount for land. The revalued amount for land is what? Is 175 million. So this is the revalued amount. We compare that with the cost. And basically this will give us what? Is it 105 million? 105 million? Yes. So the buildings, therefore, are revalued up, not the building, rather land, was revalued upward with 105. Now that one is part of OCI. So we come here and we say there was a revaluation gain on land of how much? Of 105. Of 105, like that. Then we do the same for buildings. For buildings, we will not take the cost, because buildings are depreciable. We will take this one, cost, which is, no, the revalued amount, sorry. The revalued amount, first of all, as per that point, is how much? Is 80 million. 80 million. We compare that not with the cost, but with the net book value. So what is the net book value of the building? The net book value of the building will be this one, cost minus accumulated depreciation, which we have in the trial balance. Can you see the accumulated depreciation for buildings? Is it 60? Yes. So therefore, the net book value for buildings is 140. The buildings were revalued to 80 million. So meaning that the value for buildings reduced. The buildings were revalued downward because this one will be 140. The buildings were revalued all the way to 80 million. 80 million. So that means that buildings where there was a revaluation loss of what? There was a revaluation loss of 60 million, from 140 all the way to 80, a revaluation loss of over 60. So that means that we have a revaluation loss here. Buildings, we have a revaluation loss of what? Over 60. And basically we record it here as a negative because it's a loss. Is what? Is a loss. Now, there is still something we need to compute here, the depreciation on buildings. But before we do that, also these two items will come here. So we have a devaluation gain on land. So that will go to which column? This column for devaluation reserve. So the devaluation gain for land, 105. We record it here as a positive. And then we have a devaluation loss for buildings. For buildings, we record it here as a negative 60. Negative what? Negative 60. Sasa? Yes, negative 60 like that. Then what we need to do, we need to go back to that point and we compute the depreciation on buildings. Depreciation on buildings. Now, before we do that, there is something we need to do here in relation to getting the useful price. Now, can we go back to that point? And I want us to be together here because there is something which you are told here. We need to understand very well. So in relation to point number 2, we are told that these buildings, there is somewhere we are told that the estimated useful price of the buildings before the evaluation was 50 million. So when these buildings were acquired, the company estimated that the useful price will be 50 years. 50 years. And then you're told, however, can you go to that statement? However, the evaluation did not change the useful price of the building. It basically means that from the date now the building were revalued, we are going to compute the depreciation based on the remaining useful price. So remember, these buildings and land were acquired back in 2008. So they were acquired on 1st of November. That is the information you have in note 2, the first sentence. They were acquired on 1st November 2008. When were they revalued? Who can be able to recall? They were revalued at the start of the current year. The current year started 1st November 2023. That is when the current year started. So basically, we need to determine how many years do we have here. How many years do we have here? Our building at this date had been used for how many years? Such that from the date it was revalued, we need to determine out of these 50 years, what is the remaining useful price? And that's what we are going to use in computing the depreciation per annum for the current year. So how many years do we have between these two dates? Can you give me the number of years we have between those two dates? Tuko na miaka ngapi hapa? How many years do we have between those two dates? I'm told we have 15 years. I'm told we have 15 years. Is that the position? Do we have 15 years? Tuko na 15 years? I think so. We should be having around 15 years, because basically this year, mwaka, the previous year ilisha 31st of October 2023. That is when the previous year ended. Yes. So from this date, 1st November 08 to that, do we have 15 years? I hope, can you confirm? Can you confirm how many years we have there? You can literally count. You can literally count because we may be having 14 or 15. Tuko na miaka ngapi hapo? Naambiwa 15, naambiwa 14. Which is correct? So maybe tunaweza count. So mwaka ya kwanza hapa, remember, ilisha 31st of October 2019. We count from that date. We count from this date. Is that correct? Are we counting from this date? Yes. 2019, not 2019, sorry. 2009. 2009. Anna is saying no. When are we supposed to yes, 2009, 2009. So tutasema 2009, 2010, 2011, 2012, 2013, 2014, 2015, 2016, 2017, 2018, 2019, 2020, 2021, 2022, 2023. Yes, 2023. So how many years? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15. I'm getting 15. Ama tumekosea? We can redo it afresh. 2009, 2010, 2011, 2012, 20, 13, 14, 15, 16, 17, 18, 19, 20, 21, 22, 23. So tuko na 15 years hapo. Tuko na miaka ngapi? 15 years. So basically this building from this date to this date ilikuwa imetumika miaka ngapi? Ilikuwa imetumika miaka 15, 15 years. So at the date it was revalued, because we are told its useful life never changed, the remaining useful life ni 35 years. So why do we need to do that? The reason why we need to determine the remaining useful life at the date the building was revalued is for us to be able to compute the depreciation for the current year. From the date the building was revalued, we will compute depreciation not using 50 years, but using 35 years. Using 35 years. So, and we compute the depreciation equally based on the new value. What is the new value of the building? The new value of the building ni miaka ngapi? Ni value gani? The new value of the building ni 80. And I hope those values that hatuko interchange. Is it supposed to be 80? Ama ndio ilikuwa 70? Because the value for land buildings 175 for land, and for buildings was, yes, 80. Yes, so it should be 80. It should be 80. But here's what is a question from the past paper, but whoever was setting this question, I think I changed his figures, but no problem. Yes, because I think if figure will require a building, and then this one I think was supposed to be for buildings, this one was supposed to be for art, but we work with that value the way it is given. Sasa, yes. This is a question actually from the past paper, but the person who was setting the question, I think he interchanged those particular values. So, kwa hivyo tutachukua the new value for the building, 80, we divide that with 35 years. We divide that with 35 years. So you'll see that we have some decimals there. So which is, to the nearest whole number, we have 22, 86. 22 what? 86. So are you getting that, the depreciation? Are you getting that depreciation? I've said, once we revalue an asset, and I think there is a similar question we did. Once we revalue an asset, we compute the depreciation using the new value. Using the new what? Using the new value. Using the new value. The new value is 80 million. So that is what you're going to use in computing the subsequent depreciation. Sasa, yes, that would be used in computing the subsequent what? Depreciation. Tuko pamoja? Yes. So though nimesema hii swali kuna makosa ilifanyika, I think the person, this is a question from another paper. So the person who was setting the question just interchange those values. So tutawaka na ile value ya 2286. 22 what? 86. Sasa? Yes. So that's basically how we compute that. So that which was required in relation to that node, note number 2. So, and I think we are done with that, though we will use that particular information here. In fact, before we move to the other point, can we compute this? We can first of all consider land buildings. So the value for land which you're going to include here is the revalued amount. Buildings were revalued, sorry, land was revalued at this. So the new value for land which you're going to include here is not 70, but 175. That is the new value. Then for buildings, the new value for buildings is 80. But for buildings, we will less the depreciation for the current year. Remember, you see that once an asset has been revalued, we ignore the previous values, including the previous accumulated depreciations. So what we will consider here for buildings is the new value, 80, minus the depreciation for the current year only. Sasa? Yes. So let's go back to still point number 2. I want us to compute depreciation on plant. Yes, that is what I want us to compute in. Depreciation on plant. The depreciation on plant, we are told will be what? The depreciation on plant, we are told, will be 15% using the reducing balance. Reducing balance, we compute depreciation based on the net book value. 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 So we take what? We take 15%. The net book value is equal to the cost. What is the cost of plant in the trial balance? It is basically 156,000. 156 minus accumulated depreciation. Accumulated depreciation for plant is 26,000. So the net book value is 130. We get 15%. We get 15% of that. 15% of 130. So, and what are you getting here? 19.5. Yes, 19.5. 19.5. This one will be included within the cost of our sales. That's basically what you're told in note number 2, the last paragraph. Depreciation had to be included under the cost of sales. Yes, then finally here we can deal with the plant. So for the plant, tutachukua cost ya plant. Actually, we can just do this. For plant, we take this one, 130, because that is the cost minus accumulated depreciation. We take this, we just less the depreciation for the current year only. Sasa? Yes. So that will be plant. Tuchukue 130 minus 19.5. And actually, we will be done with that because we don't have any other item of PP. So can we first of all get to the final values here before we move? So we have 175,000 plus 80,000 minus 2286 plus 130 minus 19.5. And basically, I'm getting 363, 214. 214. Is that what you're getting? Is that what you're getting? Yes, confirmed. So we are done with the point number 2. We are done with point number 3. Let's move to point number 4. Point number 4, we are told the 8% loan stock were issued on 1st January 2024, and the interest is payable 6 months in arrears. So what is important is for you to note the date when these loan stock were issued. These were issued during the current year, and they were issued 1st of January 2024. When is the current year ending? The current year ended on 31st of October 2024. So if you count the number of months from the date they were issued to 31st of October 2024, hapa tuko na miezi ngapi? Hapa tuko na miezi 10. So if we have 10 months, it basically means that the interest the company was supposed to pay on this loan stock should not be for the whole year, but rather should be interest for 10 months. But there is something equally which you are told in that point, that the company pay the interest over 6 months, or the interest is payable 6 months in arrears. So the company pay interest of 6 months. After every 6 months, the company pay interest. So automatically, when this year was coming to an end, because we have 10 months here, the company had only paid the interest for the first 6 months. So it means that there is part of the interest which was not paid, and that one should be added to this finance cost, because the interest expense for the current year in relation to this should be 8% of the year value, 50,000, times 10 months out of 12. But we are saying that what the company had paid this one, this has to be for 6 months. That's yes. So because if you take 8% of this is 4,000, half of 4,000 or 4,000 times 6 over 12 is 2,000. So the company had paid interest for just 6 months. Is that what we recognize here? What we recognize here is the interest expense for the current year. For the current year, which should be for 10 months. Sasa? Yes. So this will give us what? We have 8% over 50,000. Yes, 8% over 50,000, which will give us 4,000 divided by 12 times 10. So that is 33. 33. Yes, 33. So meaning that the company had, out of this, the company had paid 2,000. So the amount which was not yet paid is 1333. So that amount not yet paid is part of the current liabilities. So we will say there was accrued interest on loan stock, which is part of the current liability, 1333. We recognize it there as a liability, and also we add it to this, plus 1333. So we have so many decimals in this question. Yes. So, but that one should be the correct treatment. So we are done with that. Let's move to the last point, is about tax. Let's move to the last point, and then we get the final values. So we are told that the income tax for the year which ended 31st of October 2024 is estimated to be 28.3. 28.3. So automatically in this question, we don't have any over or at the provision of current tax in the previous year. So that value do not have any adjustment, no adjustment. That is the current tax. The current tax. So the current tax is what? Is 28,300. We recorded it as a negative. And then we are told in the same points, the deferred tax provision as at the end of the current year was to be increased to 14.1. So it basically meant that the deferred tax at the end of the current year will be increased to 14.1. So that deferred tax provision at the end of the current year is basically what we recognize here. In other terms, the deferred tax at the end of the year, because we said this deferred tax which we recognize here as a liability, this money which is set aside from the company's profit to be used in terms of paying the taxes in the future. So the deferred tax at the end of the year will be increased to 14.1. Then if you go back to the trial balance, how much is the deferred tax in the trial balance? Who can be able to see the deferred tax in the trial balance? The deferred tax in the trial balance. The deferred tax in the trial balance. The deferred tax in the trial balance is 12.1. Now remember what we said is that what we account for as far as the deferred tax is concerned during the current year is the increase or the decrease. The deferred tax at the start of the year, that is the deferred tax liability at the start of the year was 12.5. The deferred tax at the end of the year is 14.1. So what do we have here? We have an increase. We have an increase of what? We have an increase in deferred tax or an increase in provision for deferred tax of how much? Because that is what we account for during the current year. So this is an increase of what? Is it 24 or Tito? I don't think so. Oh yes, it should be 24. It should 24 AMA 16. It is 16. We have an increase of 16. So an increase in deferred tax liability, we said, is known as what? Which name is given to this? Increase in deferred tax liability. Increase in deferred tax liability. Tulisema jina hiyo ni gani? Which name do we give to, or Tito is not a liability? Which name do we give to an increase in deferred tax liability here when preparing the income statement? Which name is given to that? We did the same in the other question which we did in our previous class. Increase in deferred tax liability. We said you just need to recall how were you accounting for an increase or a decrease in a provision for bad and doubtful debts. That is what you just need to remember. An increase in a provision for bad and doubtful debts, that one you are accounting for it as an expense, an increase. So a decrease in provision for doubtful debts, you are accounting for that as an income. And therefore, we said an increase in deferred tax liability, that one is a deferred tax expense here. An increase is a deferred tax expense. But if it was a decrease, check the other question which we did. I think in the other question which we did, we were told the deferred tax liability was to reduce. If it was to reduce, I said that is a deferred tax income. So because we have an increase there, this is a deferred tax what? Expense. So the deferred tax expense is the increase, which is basically how much? Is 1,600. And because it's an expense, we record it as a negative. And I think in our case, we are done. So what we just need to do is now we get the final values. We get the final what? Values here. So let's do that because I think we are done. So the revenue will not change, 278,400. So let's get the final figure for the revenue. For the cost of sales, cost of sales, we work out that. We have 37,800. We compute this together. We have 78,200 plus 78,200 minus 43,200 plus 18,347 plus 22,86 plus 19,500. 19,500. And basically that will give us what? That will give us 112,933. 933. That is basically what I'm getting. So please confirm whether you're getting that value. Is that what you're getting? Yes. So having that, we move basically to, in this case, we said some of these values, like the gross profit, you may decide not even to compute that because we said what is marked ni hiyo revenue na hiyo cost of sales. So gross profit hata unaweza achana nayo. So this income from investment here ina adjustment, na tulisema the beauty with this is that this value hata ukiacha hapo bado itakuwa marked. Sasa hata ukiacha hapo bado itakuwa marked. Sasa si lazima uirecord hapa mwisho. Tuko pamoja Evans? Hiyo figure hata ukiacha hapo it will be what? Itakuwa marked up. Sasa distribution haina adjustment. So let's just record it here, and because it's an income is an positive. When recording an expense there lazima uweke kama negative. Otherwise ukirecord kama positive hiyo inakuanga wrong. Lazima uweke kama negative. Admin no adjustment. Finance we get the final value. We have 2,000 plus 69.74 plus 13.33. That will give us 10.307. So no need of even computing this value. After easy, no need of computing those values because all these are not marked. So what we said will be marked here. Easy figures as to record up. So these are the figures to earn you the marks. Easy figures easy. These are the figures to do what? To earn you the marks. These figures here. Yes, so those are the values which are marked. So then we do the same here. Is there anything we need to bring here? I think what maybe we can bring here is the profit after tax. We no need of computing that because that will give you a lot of work, and which now will affect this. No need of doing that because what will be marked here are these entries. These entries we have there. Sasa? Yes. So let's move to our statement of financial position. And I think we have the value for PP investment, long-term investment, right of use, receivables, no adjustments. And tumesema hiyo value hata ukiacha hapo ya receivables, bado itakuwa marked. Sasa? Hiyo value hata ukiacha hapo itakuwa marked. Acha tuipeleke huko mwisho. Equity here we will start with the share capital. Share capital will not change. There is no transaction which affected share capital, it remain 150. Retained earnings hii tunaweza achana nayo. Si lazima tu compute kila kitu. That's basically what we say. Revaluation reserve itakuwa this minus that. Revaluation reserve, the net amount itakuwa 45,000. 45,000. 45. So we already have the lease liability, the deferred tax, this one. Account payable, no adjustments. 33,400. Bank overdraft 15,400. Na tumesema hizi figures hata ukikuja uziache hapo zote zitakuwa marked. Sasa yes, that's why nisema I've insisted on the need of that skeleton, because in some instances you may not be having time even to go through the additional information and you make those adjustments. Sasa yes, but tumesema once you come up na hiyo skeleton, hizi values umezirecord hapo, they will still earn you marks. Sasa they will still earn you marks. They'll still earn you marks. So that is it. That basically what was required as far as that question is concerned. It was a very good question, though. I'll say that this is a question which came from another question which was examined some time back. So the